If a person is not comfortable with investing in stocks, then should they invest in safer stuff like Singapore government bond? I think if we know ourselves whereby we are unable to stomach volatility and we know that stock market is not the right thing for us, it's good to stay out. But there's a very dangerous mindset that bonds are actually safer than stocks.
Yes.
Because especially when it comes to
high flux.
Not Singapore government. Singapore government.
not Singapore government bond.
So yes, I very long never do this. As you
I
can.
also very long never do this.
Yeah. Why?
I think more writing, more thinking.
It's more your thing.
It's more tiring. Yeah. If it wasn't for you, I wouldn't come on the show. So
must capture that. Then the sponsor will know I am important. Okay, must capture that. But okay, yeah. So thank you for coming on the show. Yeah, would you like to introduce yourself for everybody that somehow don't know you yet?
Yeah, so my name is Thomas. I write about businesses, investing concepts at steadycompounding.com. So that's why I break down a lot of complicated concepts into like bite-sized content, easy to understand for most people to pick up investing that way. Yeah.
In what sense most people? You sure for most people?
I think it's for most
see
people.
quite cheap, like I read the thing and say, I mean I like it. I'm not saying it's bad, but like is it for most people?
I think like the blog will cover everything from beginner to advanced. So like there's one segment whereby if you're a beginner, you go there, you put in your email, then I'll start introducing you to the world of stock market, and then you will get like periodic emails that's customized for you. So people still get to choose like
where they want to go, which path.
But if you want to go like really super in depth, like where I break down businesses like Amazon or any sorts of businesses, right? Then you can go towards there also. That's where you see a lot of the numbers, valuation, and all that whatnot.
Yeah, steadycompounding.com. Inside got a lot of GIFs and memes also.
Oh yeah,
It helps. Okay, I read stuff. It's like, oh my god, this GIF is just, it works. Right? I think people are so used these days to have that, right? Okay. And yes, you, Anthony, you want to introduce yourself?
Hi, I'm Anthony again. Finally in the new studio.
Yes,
hooray.
yes, hooray.
That's good. Yeah, but myself, we used to host TFC market updates. So we do a lot
come back one.
We will come back in a new improved form. We focus a lot more on the investing and returns part of the personal finance in the TFC space. So happy to be here to talk more about markets.
Yeah, and that's why we are here today, right? Essentially to talk about investing, because we are starting to get more and more questions around this. It feels like people, maybe because the market kind of,
sentiment change.
Yeah, sentiment change, right? So somehow everybody cares now. The algorithm more supportive, so you must do content, right? I think that's the problem with the content landscape. But that's a different discussion. So today we're going to do a two-parter around investing for beginners, right? And we'll do a giveaway, but the information come out in part 2, right? So you must listen to both parts, like, share, subscribe, okay? But anyway, so today we're going to talk a little bit about this whole investing thing, right? Maybe we can start with just kind of putting out there, why do you all think like average Singaporeans should invest?
I think like not just invest, but also to truly learn how to invest. Because I think when COVID hit and everybody stayed at home, right, there was a lot of new investors that came in with the right intentions of growing their wealth, right? Because when it comes to investing, ultimately you're trying to get your money to work for you, right? Otherwise you'll work until you die.
That's a fanciful way of saying, oh, you got intention, but very jalat. Anyhow,
So when that first happened, right, then you see Reddit come out, Wall Street Bets come out, a lot of new investors. And when I was talking to a few brokerage houses back then, they say like record number of new people open accounts. So there was large amount of people coming in, but they were taking the action of investing, but they don't really know how to do it. And as a result, a lot of them got very, very expensive lessons dealt to them in the past year. The drawdown was brutal. And so like many people learned the wrong lessons, and as a result, rather than getting your money to work for you, we started to go in the opposite direction.
Working for money.
We started to work to recuperate the money we lost, right? The school fees. So I mean, throughout our entire life, there will definitely be people who are coming up to you and asking you to invest, be it, the insurance agents or property agents or any sort of people. But money is one thing I feel that you can't outsource your thinking to other people. people. So no matter what, you must have at least some sort of basic understanding when it comes to investing, because like nobody cares about your money more than yourself.
Okay, fair point. Fair point. Yeah. Just a short story about the Wall Street bets thing.
Yeah.
During that period of time, right, I was at a networking event next door, right? So at Draper, shout out to our good friends at Draper Startup House. I was there, then just like chilling. Then like there's this guy that I think works for L'Oreal or something, and then just came over and said, "Hey, so yeah, I heard you do a podcast. What do you think of Wall Street bets?" I was like, "What the hell is Wall Street bets?" So I didn't even know about that at the point in time. Shortly after, I knew about it, right? Shortly after that whole thing, just kind of was like, "What the hell is going on?" Right? So yeah, that's a short story. Shout out to Draper. Yes. Please continue. Tell me.
I mean, kind of agree with you. Your money is most important. You have worked hard for a pot, essentially, of gold. So not only do you want to work for money, you want your money to kind of grow or at least beat inflation, and it doesn't lose value over time, right? So I think that's one of it. But to me, the focus is, I shouldn't say this on the investing podcast, but it's not so much about investing itself. It's about money management, right? And why I personally want to invest is because I want to retire early, and fine, I can buy ETFs, I can do the usual DCA into a 3 fund portfolio, and that's easy, right? Everybody can do that. So many solutions to do that now. If you want to sponsor us, great. But,
love it. Shout out to you. You can put here, put there, put my face. Yeah.
But I think the problem is when you retire, what next, right? Do you sell 4% every year to fund your withdrawal rate? What happens if it goes down? So it's all about managing you think about you as, in a sense, a business, right? Which you'll appreciate. Then it's about managing your cash flow, managing all these things, so that even when you retire and you're supposed to enjoy life, you are able to actually enjoy life, right? And to me, investing is something you build up towards that skill. It's something about learning, okay, fine, the market goes down, I still have enough money to spend to do my travel and all that. Yeah.
Sounds like me. So I come from a much simpler view of these things. Right? Okay, of course, I don't fundamentally disagree with like your ideas of like, why should people invest? Because you care about your money the most relative to other people. Half the time they just want to sell you something. Okay, that one I agree. And you want to build up towards a retirement and all that jazz, right? But when I first started investing, it was just because I got a lot of money sitting around and I don't know what to do with them, right? And then I have a friend who is investing in the markets, in the stock markets, and I was like, hey, teach me. That's how I started. And I do think that's where a lot of people will begin. It's like, hey, so how I got some money already, what to do, right? And then they start shopping for ideas, and depends on who are the first 3 people that they interact with, it will really shape where they end up, right? So that's kind of, so at least my thought process at that point in time was really just, hey, I got money sitting around, what to do, right?
We are very high-minded, right? We talk about the philosophy.
Very philosophical, right? But that was all it is. And of course, as much as I'm not the biggest proponent of like capitalism and big capital and all that shit, right? But if you ask me, right, I would rather, be on that side on some level, right? So I would love to make more money and invest it. And all
at the end of the day, who doesn't want more money, right?
Exactly, right? I think that's the idea, right? Like investing in general. Yeah, okay, fair. So you heard a few pointers as to why you should invest. I hope one of the pointers resonate with you. I think we all come from a good position in our hearts, right? Hoping that you will make better use of your money so that you can benefit yourself towards a life that you want, right? So that is that. Okay, but then the next question is, why the stock market? Right, because all of us are invested in the stock market. I mean, primarily, I believe, right? Or maybe your crypto portfolio just flew up.
My property also.
Oh, okay, fair, yeah. So, why the stock market? I think we narrow down the discussion. Okay. So why do you invest in the markets?
I think for myself, I have a fascination with how businesses work. So if you are a very curious person about how things work, then I think a stock market is a good place for you to actually learn about the different business models, like, have a shot at thinking why this business will be bigger 10 years from today. And when I first started out at around 17 or 18 years old, the stock market was great because
Not so noisy.
You didn't need a lot of, now it's even better because now you can do fractional investing, right?
And now you don't have 1,000 share lots in there.
Today is sponsored by...
Last time when I invested in Singapore stock market, it comes in 1,000 shares.
Like one DBS lot is like 15,000.
It's crazy.
But now you can buy almost anything under the sun because of fractional investing. So you don't have to start out with a huge capital base as compared to something like property, for example, right? You don't need a huge capital base. It might be a bad thing also. It is also extremely liquid, right? You can buy, sell extremely fast. And so to me, the stock market offers me a chance to, not just indulge in my curiosity for businesses, how things works, but it's also a place whereby, when I invest in a business, I'm a business owner. So when the business is growing, reinvesting the company, making it stronger, then I get to ride on the earnings power, on the growth of all these businesses without me having to put in an extra ounce of work into running the business itself. Yeah. And I think the best thing is when I first started out very, very young, you
say until like you're like 40 years old, man.
No.
How many decades ago was that?
How many decades
Yeah, so
ago?
it's
Was it
about
last millennium?
15 years ago.
Yeah,
So
15
still
years.
this millennium.
Yeah, so quite long ago.
50 years is still
So
quite long
ago.
ago.
So, but the main thing is you're able to start with very little capital. And that is important, especially when you're starting out, because you don't want to lose or you don't want to pay huge tuition fees when you first begin, right? So the small capital base would be helpful at the start.
Then crypto, crypto very small, very liquid. Can
Super
go in.
liquid. Love
Yeah,
it.
super liquid. The market ever trading. Yeah, what's your take?
Yeah, so when it comes to crypto, right, there is no cash flow underneath all these instruments. And when it comes to me putting on my investor cap, whenever I invest in a company, it's always about how much money they can make in the future. But with crypto, I see it more like investing in an art piece, for example, right? It's dependent on how much the next person want to buy off this asset from me. And that is not my game. Like, I don't have the eye to see which art piece, like which is the next Mona Lisa by somebody else would be off at a higher price, right? For me,
I'm the next Mona Lisa.
So you'll be in a painting, right?
Yes.
So we're going to have a coconut coin.
Yes. Maybe someday, put my face. I'll be the
Talk about it for
001
3 years.
NFT, right? Yeah.
Michael cycle already. We're still talking about
That
it.
cycle already. We're still talking about it. Yeah. Okay. Fair. I think that's a fair point. I of course also come in from the whole it just made more sense to me at the point in time. It's just easier for me to understand, right? But I'm not saying that the other methods are not good. Right, but it's just within the parameters of this discussion, I think the stock market is what we're going to talk about.
I think it's really about ease of access. That's right. It's really about liquidity. But that's kind of a double-edged sword, right? Because I've an investment property, I have stocks, I have crypto. I really just focus on the equities. I've made a decision. That's it. 3 years, I can't touch it. I can't sell it. Maybe it's a new build,
so
I
you're not
can
going to
rent
make
it
your
out.
swings. You're not going to make your
So I mean, I'll make that swing, but that swing is 3 years, right?
Okay.
It's not a 3-month, 1 year time horizon. It's just a 3 year. If you're a long-term investor and you say I will hold for decades, okay lah, fine. 3 years is a very short time, right? But
that's why all the property investors all white hair one, ma.
yeah.
See, it's like
Or they are the sons of property investors, right?
Yeah.
But and sometimes I forget that I have property because I bought it. The money just comes out of my bank account every month to pay the loan. But that's it. I can't do anything. It's an asset that I can't touch. What's the point, right? And that kind of leads to a problem. It's good because you don't worry about it every day. There's no daily fluctuation.
And people find comfort in that.
Yeah,
Let's be
today
clear,
I lost
right?
20k. Tomorrow I gain I'm very sad. Tomorrow I gain 20k. I'm very happy. You don't mark the market every day.
To be
right?
fair, people don't even really do that, right? How many of them keep checking the markets, right? When people are in the stock market,
you have
the
software
property
that
market.
tells you what happened every day.
Yeah.
So I get email alerts every day.
No, I mean the property market.
Property, you don't.
Yeah, exactly. Right. So, and I think a lot of Singaporeans find that comfort.
Yes, there is a comfort there.
Yeah, it's there, lor, right? Worst to worst, I got 10% less. Don't think worst to worst, right?
10% less of a $2 million property is 200k, bro.
Yeah, exactly. It's there, ma. It's there, right? Because they don't realize that they're levered up, right?
Yes.
When you're investing in the property, you're levered up. So the profits is exciting, yes, but the loss is also equally exciting, right? So that's a different discussion.
And you're like one and done or two and done. You can't keep iterating and fine tuning your process and fine tuning your analysis, right? So it's quite unrepeatable. Really, what you need to focus on is the market cycle more than and a bit of the individual property. So I think that's where kind of equities have that attraction to me. It's a bit cerebral, it's a bit self-reflective. It's like, okay, fine, I did this. Why did I do this? Is it wrong? Is it correct? Am I correct? I'm correct. Yes. Good job me. I'm wrong. Never mind. I learn. I redo. Right? And you can keep iterating and you can keep learning, and that improves you in the end. Whereas if every lesson you learn takes 3 years, how many 3 years do you have and how much capital do you have to keep investing and keep learning lessons to actually make money? Right? 15 years down the line.
So then, do you still believe in long-term investing in that sense?
Yes,
because
and
3
no.
years is a cycle in
Yeah, 3
your
years
head.
is a cycle. I think we'll talk about this, I think, in part 2,
Yes.
where I kind of have a bit of a beef against long-term investing.
Love it. I love that plug. Right?
Yeah.
Must listen to part 2. Yes, continue.
But I think, and obviously we'll disagree.
Yes.
Because that's your thing,
You're the
right?
long-term one, right?
Yeah.
Very long.
Never sell.
No, not saying we never sell, but there is a sell criteria.
Yep.
We'll talk about sell criteria. Part 2. Part 2. Yes.
Yeah, but I think you have to think about it in terms of, what are you in this for? You know, are you in this to make as much money as you can in as quick time as you can, right? In which case, well, it's not property. It's maybe even not equities. It's maybe crypto. It's maybe go and buy Toto or maybe go casino and gamble, right? So there are many, many ways to make money. Different risk profile, different return profiles in a sense. So no, it's up to what you want lah.
Yeah,
and I think equities just kind of suits what I need to do to get to retirement.
Yeah, fair. If you have $1, you want to make $1 million, then don't just go to buy Toto, right?
I mean,
that's the idea.
Yeah. Because even your cheapest transaction fee is still
it's not gonna make sense.
Work.
Okay, fair. So then, I know there are a lot of people out there that, you know, they have some money, they accumulated some money, and then they will think like, oh, maybe I just very safe lor. You know, like play safe, right? Buy government securities. You know, I mean, I'm not saying it's bad. Okay, maybe I am. Okay, so hey, what's your position? Make up your mind. But anyway, yeah. So I'm sure amongst our friends, there'll be a lot of people that think like that. So they associate themselves as risk averse. And by extension, their investment methodology is risk averse. And by extension, they believe that buying government securities and bonds is a safe way. Yeah. Right. So what is your take on that?
Okay. So, I have a lot of friends like that. I literally have friends who compare
I know we were gossiping about it the other day.
And then they're like, oh, this bank higher FD rate. I move my 100K there. So like 75K, 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 like 6 different banks. Or like Great Eastern, I think recently had an endowment, 1 year fixed endowment, 4%. Everybody chung into it.
I got a lot of emails recently. A lot of these kind of,
GXS opened a new 3.6% account. Everybody chung into it, oversubscribed. So, I think Singaporeans love having cash and Singaporeans love chasing that 0.5% on that 50K, 60K per year, 0.5% per year, right? If it's 50K, it's 250 bucks.
Yes.
And then to me, that's kind of losing sight of the bigger picture because you don't even need to beat the market, right? You put in equities. If you can hold longer term, that's 9%. That is 18 times that 0.5% you are kind of putting time and effort into chasing. So to me, I think having cash is great. I have too much cash. I need to start investing more. I need to be more disciplined in my approach. But at the end of the day, there is an opportunity cost for all of this cash that you're holding. If you do nothing with it, you spend so much effort to get that little reward. It's safe, sure, but you must remember you're still putting in time, right? Is that how you value your time? Or is this the best use of your time where you could be doing other things with it, right? Or you could just even, I don't want to bother queuing that 2 hours or that 3 hours to figure out how to open a new bank account and transfer my money there. What I will do is I will spend 3 hours, I do a course, I get a better job or I get promoted, right? And that could be a better use of time. So I think maybe it's a difference in mindset where a lot of people who hoard a lot of cash are very defensive. They are worried about their cash values going down. There's like the 节流 part of Kyrene 节流, right? I control that.
节流.
Whereas
very ching chong, today's episode. Yes.
I stood the environment.
Yes, you are.
But then at the end of the day, my personal belief that we should be Kyrene. We should be earning more. We should be pushing that boat out, right? And then if that happens, the rest sub sway lah. Don't need to worry too much about
Recently,
it.
you got a lot of Chinese clients, is it?
Huh?
Your Mandarin improving.
No, I was talking about force majeure in Mandarin yesterday.
Okay. Fair. Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. So on that basis, I think we have set some grounds on like investing as like why people should invest, what are their goals, how to think about this thing, right? Okay, so then we move into this discussion around like what is the right investor mindset? Especially I want to highlight things about like some mindsets it will help you thrive in your career or helps you thrive at home. But as an investor, these things don't work, right? So what is any things that you think that it's not a good mindset?
I wanted to touch a bit on the point earlier whereby you mentioned like if a person is not comfortable with investing in stocks, then should they invest in safer stuff like Singapore government bond? I think like if we know ourselves whereby we are unable to stomach volatility and we know that stock market is not the right thing for us, it's good to stay out. But there's a very dangerous mindset that bonds are actually safer than stocks.
Yes.
Because especially when it comes to
high flux.
Not Singapore government. Singapore government
not Singapore government bond.
No. And to be clear, bonds are thrown around quite a bit, right? And there's a whole structure in itself. There's a lot of intensity there in terms of discussion also.
Right.
Like how a lot of uncle auntie kena the high flux thing, right? Right. Essentially,
not just high flux, but also like SWIBOR, NOL, the layman mini bond. And the truth is like
NOL, he take umbrage with you. Yeah, please continue.
And the truth is, when you start to work, when you start to have a bit of money, your bankers are going to come to you.
Yes.
And they're going to tell you this
and
is
they got
4-5%.
your information.
They know how much you have.
They know
how much you have. They're going to tell you this is 4-5%. This is very safe. And the truth is, they probably don't know the products themselves. Because when I look at the financial statements of HiFlux, for example, every year they are reporting net profit. But if you look at their cash flow statement, every year cash is going out. And they're making for the shortfall by borrowing from our banks themselves, our DBS and all that whatnot.
Yes.
And then what they're doing is they're just restructuring this debt and then pushing it out to retail investors. I have quite a few friends who told me these bonds, they are still alive, so I'm not going to name them. But they told me like, wow, this one 5%. My father put most of his net worth in this one bond. And I tell him, this gearing ratio is over 300%. Would you lend money to someone who borrow more than 3 times their net worth? If you wouldn't, and especially if it's a developer who is extremely cyclical.
Developer.
I don't say.
All developer issue bonds.
All developer issue bonds.
But when it comes to developers, it is a very cyclical business. I don't know whether Singapore or not. Maybe overseas one. Yeah, but we cannot just assume that they will be safe. We cannot assume that they will be safe.
You still need to understand the company.
Yes.
I think fundamentally bonds are debt instead of equity. So maybe in a sense, higher up the capital stack or that theoretical jazz, right?
But
you
it's
still need to know the
by
company.
the time the shit happens, right, really is the liquidation process. How much can you really get back, right? I really don't know.
Especially we need to ask ourselves, if it's so risk-free and the interest is so high, why don't the bank lend themselves? Why would they want you to take over, this bond profile, right? Is it too risky for them? If it's too risky for them, then why is it safe
not
for
risky
you?
for you?
Or is the returns too low for them? Right? That's
possibly,
the other way.
Yeah,
Right?
possibly. Because they shift money, they make more.
Yes.
Right. So okay, then we continue the discussion around the whole mindset thing. Right. So I think that's a good start around it. So what do you think is a mindset that doesn't work?
I think if you come in and you expect to immediately win, that doesn't work, right? You can study all you want, to be honest. You can read all the books.
So we are not talking about the people that just don't want to read and just go in, right? We're talking about
if you don't want to read and you just go in,
then what the hell you're doing? It's your problem.
You can win, but you need to kind of semi-realize or hope that you win by luck and not skill, which is fine. It's a acceptable strategy to try your luck, right? Nobody's saying that you can't be lucky. If I'm naturally lucky, great. I'd rather be lucky than be good, right? So frankly, I'd rather be lucky than be good. But I think if you want to do this properly, in a sense properly, then you need to kind of be able to live with the fact that this is long term, or you will have to keep doing this. You cannot just, I do this for 3 months, I'm done, rest of my life. Right? It doesn't work that way. Even if you want to be the most super passive investor, you just want cash flow, and you think REITs are great. We buy REITs for cash flow, which is a relatively silly idea. Then you still have to monitor your REITs. What if your REITs suddenly go kaput, like the US office REITs recently, right? Then you still need to read the news, still monitor. So I think that's kind of the mindset that you need if you want to do, and maybe we talk about why we should do it, but if you want to do equities investing for a longer term, or you want to learn to manage money for a longer term, you kind of have to live with the fact that you have to put in some effort. It's not.
So it's not that passive.
It's not that passive, and
I always have problem with the word passive. But yes, please continue.
And you can go to robos and all that. I can just chuck money in. I put my money in robos as well, because SRS, good money, right? But at the end of the day,
tax incentive.
Yes, tax incentive is great. But at the end of the day, you need to know what you're buying, because as Tom said, it is your money. Nobody else will be responsible for it. If you lose money, nobody will pay for it except for you, right? So I think people have to get that straight and be comfortable with that before they even do anything.
Yeah. And for me, right, I think I'm more specific around this, right? In the sense that every time you see a lot of personal finance content, right, or people in the space, right, they always try to attach the amount of money that you make to the amount of hours that you work, right? So there's a lot of that, because it's trying to draw the pain of work to tell you not anyhow spend. Essentially, that's the main idea, right? They tell you evaluate this thing based upon how many hours of work you make, blah, blah, blah. And then so that you don't anyhow spend, right? So when you carry that mindset in your early days of like gathering your money, right? Okay, that kind of helps, right? It kind of help you direct from like splurging and all that. You will accumulate, if you hold on to that. But at some point, I realized that is damn not useful when I'm investing, because I need to be very clear and objective objective around like my risk profile. How am I managing this thing? Is this in, is this out? And I cannot feel that kind of emotions tied to the amount of hours that I work to get this amount, right? So I lose 20k, I lose 30k. I cannot think like,
no, and I think that is a fundamentally flawed comparison, right?
Yeah.
Because okay, let's say I value my time at $100 an hour. I don't want to queue 3 hours for a free croissant because that means I'm valuing that croissant at $300 an hour, right?
Yes.
But then again, I'm investing $10,000. That $10,000 is not, I mean, I work maybe 100 hours or 1,000 hours to get there, but it's accumulation of your efforts, you know, and that is your pot of gold.
Yes.
So you cannot say, oh, fine, that $10,000, I lose $1,000. It's like, oh shit, that's 10 hours of thing wasted, right?
Yeah.
You forget that this was a combination of efforts and it will continue, you know? So it is just a flawed comparison.
Yeah. No, and it's prevalent. Right, I think this is very prevalent as an idea. People feel the pain associated with it.
Yeah, just because you have one concept doesn't mean you apply everywhere.
Yeah, exactly. It's not most concepts are not universal, right? Even Einstein don't dare to say that. Okay, universality, right? But anyway, I think that is one thing that really works well when you are a working professional, but really suck when you are investing, right? You must really throw that out together with the bath water, right? I think that is not helpful, right? If you are trying to be an investor, especially when you're trying to invest in the stock market, right? Okay, so then what is the right mindset, or what is something that you want to advocate for people when they're investing? Like, how should they think about them as an investor? What is the mindset to have?
I think something that's unique to Singapore, especially among the older generation, is that when they invest, they like to only look at the dividend yield. But when it comes to investing...
You see our reaction, we got so much to say! We vibing here. Yeah.
It's always the yield, the number and all that kind of whatnot. But when it comes to investing, we always should look at it from total shareholder returns, which means it's a function of both your capital gains or losses plus your dividends. And a lot of times when we are looking at dividends, and there's a reason why Singaporeans love dividends, because we are one of the countries that don't tax on dividends at all.
The structure incentivizes certain beliefs, right?
We have no capital gains as well.
Yeah, we also don't have. But when it comes to looking at dividend yield, a lot of people think that just looking at that number alone is because it's very easy to do it, right? And the higher the number, the better it is. But a lot of times there is a reason for a yield to be this high. Just like if when you're looking at bonds and they're offering you 5-6%, there's a good reason why it is that amount. And so when it comes to investing in stock market, it's always better to have a owner mindset, whereby you think today when I'm investing in this business, I'm buying this entire business over, and as a business owner, would I be happy to own this company? Is this company going to be disrupted or go downhill over time? Because ultimately, this is going to contribute to your total shareholder returns, which is both your capital gains and also your dividend yield.
Yeah, fair.
I mean, just to add on to that point, I guess.
So no disagreement?
Got disagreement. We'll come later, right? So, and it's not just a shot at dividend investors, right? Even value investors go, low PE means good. Right, and people forget that sometimes low PE is there for a reason.
Got problem,
right? So I think the general
turnaround
argument,
plays come once in a while.
The general argument is you don't want to fixate only on one thing, right? You want to look at the broader picture and all that, and analyze the business, analyze the company, and be comfortable that way. So know what you're buying, right? That's one. But I think I want to be a bit broader. I think the right mindset is that you need to be flexible. You need to be a bit humble, and you need to kind of know that you're not the best, and therefore, a lot of people talk about market inefficiency. This is mispriced, this is undervalued and all that. But at the end of the day, are you really that sure? And are you going to be sure for that 10 years that you are holding the stock while you wait for it to realize its true value, that you are absolutely correct, right? And to be able to hold for 10 years without self-doubt, it's kind of delusional, right? And not a lot of people have that mental fortitude to be able to do that.
Or you believe,
I mean, you are narcissistic, or you have extreme self-confidence, right? To be able to say, everybody is wrong, I am the only correct one. So I think to me, the key to mindset is be confident. You have made a decision. You have thought through a decision. You should be able to justify it and be able to defend it. But you also need to be open to being wrong, right? Not too easily. Not somebody say, oh, you might be wrong. Then, okay, I admit I'm wrong, right? But
then that already shows, right?
Yeah, that already shows a lack of conviction.
So you need
understanding. To build a conviction in your thesis, yes, but you also need to be open-minded to the fact that you could be wrong. Because at the end of the day, nobody is all-knowing, right?
Very philosophical.
I love it.
Yes.
You should just come on and talk about philosophy and language.
No, that's a wrong show. Please continue.
So if you kind of come in with that realization and come in with that mindset, then you can become a lot more self-reflective.
Yeah.
You can challenge yourself. You don't need other people to challenge you, and you learn faster.
Own self, check
Right?
own self.
Yes, not own self check, own self challenge.
Okay,
own self,
own self-challenge.
right? And then you iterate faster, you learn faster, and that improves your results over time. It's something that's process driven, right? To me, outcome is great. I want as much money as possible. I want as high a return as possible. But it's very difficult to divorce your outcome from whether it was coming from luck or coming from skill.
Yes.
Lots of people make money from Wall Street bets, right?
Yeah.
So what you want to do is really focus on the process, make sure it's repeatable, it's sustainable, it suits your lifestyle, it suits what you want to do and what you want to achieve. And part of it is being able to admit that you're wrong and you want to tweak and adjust, as things go on, as time passes. Then you are setting yourself up for success.
Okay, I know what you're saying. And a little bit about the price in thing, right?
Yeah.
I think I had a friend who runs quite a big fund, and then he hired analysts, and then the analyst been newer, right? So came in and then talk about, okay, this is blah 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 blah, and then I think the market has priced it in. Then his reply was, in what way? Tell me, how is this priced in? What's the price? How is it inside? Right? So essentially the story is, don't just copy the lingua franca of the industry, right? Think. They always say this price in. It's like, 怎么讲 price in? How is this in? Right? Like, tell me, what does it mean? Right? Undervalue on what basis? Right? So I think we need those kind of languages to have a certain signal sets, but every time people say something, you must think a bit further lah. So I think that's a good ground. Okay, that is a good ground. I like where we're going. Part 2 will have more contestation ideas.
But
Okay,
part 2 will have more like actual things that we can do.
Yes. Because part 2 we're gonna talk about with 100,000, how you're gonna start, right? So that is a part 2. Stay for part 2, and part 2 got giveaway. Okay, but before we go into part 2, maybe we can throw a teaser in, right? Like, what is one skill set that you think is extremely important if you want to be a successful investor in the stock market?
I think there's 2 ways to approach the stock market, right? One is if you don't have time or you don't have interest, then you just go with indexing. Then that will give you exposure into the stock market without putting additional.
Do you shift your position around this? I remember a few years ago you're not so big around this.
No. I mean, I've always said that if the person got no time, no interest, no nothing,
like the
just
taxi uncle in your article, right?
Just go. He read.
I read. I was like, good job. Yeah, I read. Hey guys, I do my research. Okay, that's why I'm one of the best hosts, right? But I saw the article. It said that I never give stock tip one, but I know there's one day I cave into the uncle.
So like no time, no interest, just go indexing. But if you really want to go into the stock market and pick stocks itself, one of the skill set is that you must be able to read financial statements. And if you're not able to overcome that hurdle in reading financial statements, understanding the profitability, where the company is going, then we shouldn't kid ourselves and we should just, invest in either through index or through other aspects.
Yeah. It's like a musician that don't know how to read the manuscript, right? It's like
you go by feel, bro.
It's all about
the
musicality.
DJ who just play from the thing, but never, just
The DJ that can stand in front of the spin, right? They just keep doing this. I was like, are you spinning or is that pre-done? Right? That's pre-done.
Can I
pretty. So I was like, okay. Misogynistic. Later Halima talk to you. Okay. But what about you? What is a skill set that you think is needed? I mean, I do agree with that.
Yeah, I kind of agree with that. I thought I was going to say like he needs to build a model. Then I'm already disagree. That's like financial statements. Okay, you kind of need to know the basics, right?
I think that is a must, right? Yeah. Like, there's no dispute around that, right?
Yeah, but I would say that I don't think it's the most important.
Okay,
right?
Okay.
Just
I like it. The fire is heading up.
You can go with a lot of fundamental analysis and look at the business and how it's doing. And the financial statements are a point in time reflection of that, right? But it doesn't tell you the future. And I mean, we talked about price and all that, but a reality of the company is, and you will agree with this, is that a lot of the stock price is based on future cash flows or future returns, right? So looking at what they have done, an indication of what they could do in future, but it's not the be all and all, right? So then that requires that bit of imagination of, how this is great, how this could be great, and if you're a Tesla investor, how they'll rule. So I think that's kind of where we get to. Skill sets, yes, you need to know financial statements, you need to kind of be able to think, be able to reason things out and have that logical train of thought. But I would say that there's a lot of things that, kind of built into it. And that's why you listen to our second part.
Yeah, of course. And I want to add that because I don't want people to take away thinking that, just read the financial statements and then punch in a few numbers in the algorithm and that's all it is. But actually, you must read the financial statements and the annual reports, right? So essentially...
Or you listen to like an investor call and then what people are
You have to listen to
investor
calls, okay? It's like bread and butter. of investing, at least you must go and listen to their history, right? A few of them, then you catch up on what they're talking about, right? But you can skip the analyst questioning part. A lot of them is just trying to get news, right? You just listen to the front part and contextualize for yourself. But you must take the numbers in the financial statements and contextualize it into like their strategy, their plan, what are their risk factors, what they're writing, right? And that part, I think, is the part that a lot of people like quite lazy about it. A lot of people that are just starting, right? Like, of course, if you go to the very traditional learn slowly type, then you will likely listen to those things, or you'll do it that way. But for a lot of people, they really just go to the FS, then do some sort of shortcut.
And you know who I blame for that?
What?
Warren Buffett and Benjamin Graham. Because you go with net, you look at the financial statements, done, right? But that's not how the market is now, right? And we have to kind of move slightly away from that paradigm. Yeah.
Great. I like the heat is heating up, right? Because you're quite a believer of Buffett, right?
Yeah, so like Buffett used to be like a net investor, but he gradually evolved along. But when it comes to
part two. Okay. Stay tuned for part 2. Okay. See you all next week. Bye.